Tired of seeing your paycheck disappear to taxes? What if I told you there's a legal way to keep more money? Real estate hacks can slash your W-2 taxes, save thousands, even tens of thousands every year. Ready to take control of your finances? Welcome to Mindset Money. Hit subscribe for more. One of the most powerful tax strategies for real estate investors is qualifying as a real estate professional, or REP. This IRS designation allows you to deduct unlimited real estate losses against your W-2 income. It's not simple, but achievable, even with a full-time job. Understand the requirements and structure your activities. Spend over 750 hours a year managing real estate. More than 50% of your working time must be real estate related. In the upcoming sections, we'll break down these requirements. Let's talk about the 750-hour requirement. Now, I know what you're thinking, 750 hours? That's like having a second full-time job. And you're right, it's a significant time commitment, but it's not as daunting as it seems. The key here is to work smarter, not harder. Instead of trying to do everything yourself, focus on leveraging systems and outsourcing tasks to free up your time. Hire a property manager to handle day-to-day operations, use online tools to automate rent collection and tenant screening, and build a reliable team of contractors to handle repairs and maintenance. Remember, as a real estate professional, your time is valuable. By delegating tasks that can be done by others, you can focus on higher-level activities that generate more income and require your specific expertise. Think of it this way. Would you rather spend hours every week chasing down rent payments or negotiating a lucrative property deal? By optimizing your time and leveraging resources, you can achieve the 750-hour requirement and still maintain a healthy work-life balance. Now, let's talk about the second requirement for becoming a real estate professional, the 50% rule. This one can be a bit trickier, especially if you have a W-2 job. To meet this requirement, more than half of your working hours need to be dedicated to real estate activities. This means that if you're working a traditional 40-hour work week at your job, you'll need to spend at least 20 hours per week on your real estate business. This might seem daunting at first, but with careful planning and dedication, it's definitely achievable. Start by tracking your time diligently. Use a time-tracking app or a simple spreadsheet to track how many hours you're spending on both your W-2 job and your real estate activities. This will give you a clear picture of where your time is going and help you identify areas where you can make adjustments. Remember, the goal is to gradually shift your focus from your W-2 job to your real estate business. As you build your portfolio and generate more passive income, you'll be able to reduce your hours at your job and eventually transition to working full-time in real estate. Now let's look at an example of how a typical W-2 worker can strategically transition into becoming a real estate professional and start reaping the incredible tax benefits. Imagine Sarah, who works a 9-to-5 job and is tired of seeing most of her paycheck go towards taxes. Sarah decides to invest in her first rental property, a duplex. She lives in one unit and rents out the other, instantly reducing her living expenses. She then reinvests her rental income into another property, and then another, gradually building her portfolio. As Sarah's real estate business grows, she starts spending more time managing her properties and less time at her 9-to-5. She hires a property manager to handle day-to-day tasks, freeing up her time to focus on finding and acquiring new deals. Eventually, Sarah reaches the point where she's generating enough passive income from her real estate investments to replace her W-2 salary. She quits her job and officially becomes a real estate professional, unlocking the ability to deduct unlimited real estate losses against her other income. This drastically reduces her tax burden and allows her to keep significantly more of her hard-earned money. Even if you're not ready to become a full-fledged real estate professional, there's a powerful tax strategy you can use: depreciation. Depreciation is a paper loss that reduces your taxable income by writing off a portion of your rental property's value each year. The IRS allows you to deduct a portion of the property's value annually. It's like getting a discount on your taxes for owning a rental property. Now let's talk about one of the most powerful depreciation strategies available to real estate investors: bonus depreciation. This strategy allows you to accelerate your depreciation deductions, writing off a large portion of your property's value in the first year of ownership. Think of it like this. Imagine you buy a brand new car that qualifies for a huge instant rebate. You get to enjoy a significant chunk of the car's value up front, right? That's essentially what bonus depreciation does for your rental property. It allows you to claim a large depreciation deduction right away, significantly reducing your tax burden in the first year. The specific rules and regulations surrounding bonus depreciation can change from year to year, so it's always a good idea to consult with a qualified tax professional to ensure you're maximizing your deductions. However, in many cases, you can deduct a significant portion of the property's value, sometimes even up to 100% in the first year alone. This can be a game changer for real estate investors, especially those just starting out, as it can significantly offset their taxable income and potentially even lead to a tax refund. Another powerful depreciation strategy that many real estate investors overlook is cost segregation. This strategy involves hiring a qualified cost segregation specialist to identify and reclassify different components of your rental property, allowing you to accelerate your depreciation deductions even further. You see, the IRS allows you to depreciate different components of your property over varying time frames. For example, the building structure itself might have a depreciation life of 27.5 years, while personal property like appliances and carpeting might have a shorter lifespan of 5 or 7 years. By conducting a cost segregation study, you can identify components with shorter depreciation lives and reclassify them accordingly. This allows you to depreciate those assets more quickly, resulting in larger deductions and greater tax savings in the early years of ownership. Cost segregation studies can be particularly beneficial for properties that have undergone significant renovations or improvements, as these projects often involve replacing or upgrading components with shorter depreciation lives. Let's bring this all together with a real-world example. Imagine you purchase a rental property for $500,000. By using bonus depreciation and a cost segregation study, you might create a paper loss of $100,000 in the first year. This deduction could offset your other income, potentially saving you tens of thousands in taxes. This example shows the power of depreciation for real estate investors. Alright guys, let's talk about house hacking, one of my favorite strategies to live rent-free and build wealth. Imagine living in your own place without worrying about rent. That's the power of house hacking. Buy a multi-unit property, live in one unit and rent out the others. Rent can cover your mortgage and even generate cash flow. You're living rent-free while building equity. It's a win-win situation. Now you might be thinking, Graham, this sounds too good to be true. What's the catch? Well, there's no catch, just smart tax planning. You see, the IRS offers some incredible tax advantages to homeowners and landlords. When you house hack, you're eligible to deduct a portion of your mortgage interest, property taxes, insurance, and even depreciation on your tax return. These deductions can significantly reduce your taxable income, which means you'll get to keep more of your hard-earned money. Let's say you have a mortgage interest deduction of $10,000 and a property tax deduction of $5,000. That's a total of $15,000 in deductions right off the bat. If you're in the 25% tax bracket, that translates to $3,750 in tax savings. Year after year, these savings add up big time. But wait, there's more. Remember depreciation? That non-cash expense that reduces your taxable income? Yeah, that applies to your rental property too. Depreciation lets you deduct a portion of the property's value each year, further lowering your tax bill. It's like getting free money from the IRS. Finding the right house hacking property is crucial to your success. You want to look for multi-unit properties in desirable areas with strong rental demand. Think about neighborhoods close to universities, hospitals, or business districts, where people are always looking for places to rent. It's also important to consider the condition of the property. A fixer-upper might seem appealing at first, but remember, you'll be living there, and renovations can be costly and time-consuming. Don't be afraid to work with a real estate agent who specializes in investment properties. They can help you find properties that meet your criteria and guide you through the negotiation and closing process. Remember to factor in all the costs, including your down payment, closing costs, potential repairs, and ongoing expenses like property management fees. House hacking is a fantastic way to get started in real estate, even if you don't have a ton of cash saved up. By leveraging the power of rental income and tax deductions, you can build wealth, slash your housing expenses, and live the life you want. House hacking is more than just a real estate strategy, it's a lifestyle choice. It's about taking control of your housing situation, building long-term wealth, and achieving financial freedom. Imagine being able to quit your 9-to-5 job, travel the world, or pursue your passions without being tied down by a mortgage or rent payments. That's the power of house hacking. It's a proven path to financial independence that has worked for countless people, and it can work for you too. So what are you waiting for? Start researching properties in your area, connect with a local real estate agent, and take the first step towards owning your financial future. Remember, the sooner you start, the sooner you can reap the rewards of house hacking. Now, let's talk about a powerful tax strategy that can save you a fortune in capital gains taxes, the 1031 exchange. Think of it as a get-out-of-jail-free card for real estate investors. It allows you to sell an investment property and reinvest the proceeds into a new property without paying any taxes on the profits. That's right, you heard me correctly. No capital gains taxes. Here's how it works. Let's say you purchased a rental property a few years ago for $200,000. And now it's worth $300,000. If you were to sell it outright, you'd be on the hook for capital gains taxes on that $100,000 profit. But with a 1031 exchange, you can defer those taxes by reinvesting the proceeds into a like-kind property. This means you can sell your rental property and use the profits to buy another rental property, a larger apartment building, or even raw land, as long as it's considered an investment property. The beauty of the 1031 exchange is that it allows you to defer paying capital gains taxes indefinitely. You can keep rolling your profits into larger and more profitable properties without ever having to pay taxes on those gains until you ultimately sell for cash. Imagine this. You start with a small rental property and use the 1031 exchange to trade up to a larger apartment building a few years later. Then, you repeat the process, exchanging your apartment building for a shopping center or a portfolio of single-family homes. Each time you exchange, you're deferring those capital gains taxes, allowing your wealth to grow exponentially over time. It's like a snowball effect for your real estate investments. Now, there are some rules and timelines you need to follow to qualify for a 1031 exchange. First, you have 45 days from the sale of your relinquished property to identify a replacement property. This means you need to have a signed purchase agreement within that 45-day window. Second, you have 180 days from the sale of your relinquished property to close on the replacement property. It's crucial to work with a qualified intermediary, like a title company or escrow agent, who will handle the exchange funds and ensure you meet all the IRS requirements. Failing to meet these deadlines could disqualify you from the tax benefits of the exchange, so it's essential to be organized and work with experienced professionals. The 1031 exchange is a powerful tool that can supercharge your real estate investing strategy. It allows you to defer taxes, preserve capital, and build a massive portfolio of income-producing properties. By understanding the rules and working with the right team, you can leverage this strategy to achieve your financial goals and build generational wealth. Remember, the 1031 exchange is just one of many tax advantages available to real estate investors. By combining this strategy with other tax-saving techniques, you can significantly reduce your tax burden and keep more of your hard-earned profits. So, there you have it. 4 powerful real estate strategies that can help you slash your W-2 taxes and build long-term wealth. Whether you're just starting out or you're a seasoned investor, these strategies can make a huge difference in your financial future. Remember, the key is to take action. The sooner you start investing in real estate, the sooner you can begin reaping the rewards of tax savings, passive income, and appreciation. Don't wait on the sidelines while others are building their wealth. Now I want to hear from you. Which of these strategies are you most excited about? Let me know in the comments below. And if you want more videos breaking down tax-saving secrets and wealth-building strategies, be sure to subscribe to the channel and hit that notification bell so you don't miss out on any future content.